Watch video 34 from the Workbook NISM Series 17 Retirement Advisor Certification Examination Final Feb 2024, and review the multiple choice questions and answers. 1. What is the first decision investors need to make in the process of creating wealth? A. What is the asset class to invest in? B. What is the tax rate? C. When to withdraw? D. How to diversify? Answer: A. What is the asset class to invest in? 2. Which of the following is a benefit of investing through a managed portfolio? A. Avoiding all risks. B. Lower tax rates. C. Professional expertise in managing investments. D. Guaranteed high returns. Answer: C. Professional expertise in managing investments. 3. What does diversification in a portfolio help with? A. Increasing risk. B. Eliminating all losses. C. Managing risks by spreading investments. D. Avoiding taxes. Answer: C. Managing risks by spreading investments. 4. In which economic condition is gold a preferred investment? A. During deflation. B. In inflationary conditions. C. In low interest rate environments. D. When debt markets are performing well. Answer: B. In inflationary conditions. 5. Why is it difficult for individual investors to maintain an effectively diversified portfolio? A. High management costs. B. Lack of funds and skills. C. Lack of available research reports. D. Because mutual funds provide better returns. Answer: B. Lack of funds and skills. 6. What is a key advantage of investing through mutual funds? A. Lower overall costs due to pooling of funds. B. Tax-free investment. C. Guaranteed returns. D. 100% liquidity. Answer: A. Lower overall costs due to pooling of funds. 7. Which type of fund has a fund management cost limit of 0.01%? A. Equity fund. B. National Pension Scheme, NPS. C. Debt-oriented fund. D. Private equity fund. Answer: B. National Pension Scheme, NPS. 8. What is a disadvantage of investing directly in privately placed securities? A. High transaction costs. B. Illiquidity and high minimum investment requirements. C. High taxation rates. D. Lack of diversification options. Answer: B. Illiquidity and high minimum investment requirements. 9. How does a managed portfolio like a mutual fund provide liquidity to investors? A. By offering regular dividends. B. By buying and selling investments on their behalf. C. By allowing investors to withdraw at the current NAV. By locking the investment for a fixed period. Answer: C. By allowing investors to withdraw at the current NAV 10. What is the tax benefit of investing in mutual funds? A. Complete tax exemption on capital gains. B. Lower tax rates on dividends. C. Funds are exempt from taxes on earnings, and capital gains are taxed favorably. D. No taxes on any type of income. Answer: C. Funds are exempt from taxes on earnings, and capital gains are taxed favorably. 11. What is the main source of returns in equity investments? A. Interest income. B. Dividends and capital appreciation. C. Rental income. D. Coupon payments. Answer: B. Dividends and capital appreciation. 12. Why are returns from equity investments volatile? A. Because dividends are fixed. B. Due to the large contribution of capital gains. C. Because they provide a guaranteed return. D. Because of low interest rates. Answer: B. Due to the large contribution of capital gains. 13. What primarily contributes to total returns in debt investments? A. Dividend income. B. Capital appreciation. C. Interest income and changes in the value of securities. D. Rental income. Answer, C. Interest income and changes in the value of securities. 14. Why do deposit holders face challenges during periods of low interest rates? A. Due to capital losses. B. Low interest income may not beat inflation. C. Deposits lose value. D. Interest income becomes tax-free. Answer, B. Low interest income may not beat inflation. 15. In which scenario can bonds generate good returns even during low interest rates? A. When the bond has a high coupon rate. B. When capital gains increase due to rising bond prices. C. When interest rates are expected to increase. D. When inflation is high. Answer, B. When capital gains increase due to rising bond prices. 16. What happens to bond prices when interest rates rise? A. Bond prices increase. B. Bond prices remain unchanged. C. Bond prices decrease. D. Bond prices become volatile. Answer, C. Bond prices decrease. 17. What is tax-adjusted return? A. Return before taxes are deducted. B. Return after taxes have been paid. C. Return including transaction fees. D. Return that includes inflation adjustment. Answer, B. Return after taxes have been paid. 18. How do tax-free bonds compare to taxable bonds in terms of interest rates? A. Tax-free bonds offer higher interest rates. B. Taxable bonds offer higher interest rates. C. Both have the same interest rates. D. Tax-free bonds are always riskier. Answer, B. Taxable bonds offer higher interest rates. 19. What is the post-tax return on a taxable bond paying 9% interest if the tax rate is 20%? A. 8%. B. 9%. C. 7.2%. D. 10%. Answer, C. 7.2%. 20. Why might an investor choose a tax-free bond over a taxable bank deposit? A. Tax-free bonds always pay higher interest. B. The post-tax return from the tax-free bond is higher. C. Bank deposits are riskier. D. Tax-free bonds have no risk. Answer, B. The post-tax return from the tax-free bond is higher. 21. What does automatic rebalancing in a managed portfolio involve? A. Selling all assets and reinvesting. B. Adjusting the asset allocation based on market conditions. C. Buying only short-term securities. D. Investing only in growth assets. Answer, B. Adjusting the asset allocation based on market conditions. 22. What type of portfolio rebalancing does the NPS offer? A. Rebalancing based on stock market trends. B. Gradual reduction of equity exposure as investors approach retirement. C. Constant rebalancing to maintain equal asset allocation. D. Increasing equity exposure for all investors. Answer, B. Gradual reduction of equity exposure as investors approach retirement. 23. Why do total returns in real estate investments fluctuate? A. Due to fluctuations in rental income. B. Changes in asset value contribute to volatility. C. Interest rates directly affect property prices. D. Real estate never appreciates in value. Answer, B. Changes in asset value contribute to volatility. 24. What does a volatile component in total returns refer to? A. The dividend income. B. Interest payments. C. Gains or losses in the value of the investment. D. Capital gains tax. Answer, C. Gains or losses in the value of the investment. 25. What factor leads to lower volatility in debt investments? A. Large contribution of capital gains. B. Interest income being the primary source of returns. C. High coupon rates. D. High liquidity of debt instruments. Answer, B. Interest income being the primary source of returns. 26. What is the risk for debt investments during rising interest rates? A. Higher interest income. B. Capital losses reducing total returns. C. Higher inflation rates. D. Increased liquidity. Answer, B. Capital losses reducing total returns. 27. What happens to the market price of bonds when interest rates are low? A. Bond prices increase. B. Bond prices decrease. C. Bond prices remain unchanged. D. Bonds are less liquid. Answer, A. Bond prices increase. 28. What do financial markets do to account for tax implications? A. Ignore tax rates. B. Adjust market rates for tax effects. C. Increase interest rates. D. Reduce the number of available bonds. Answer, B. Adjust market rates for tax effects. 29. Which investment pays 8% interest tax-free? A. Taxable bank deposit. B. Tax-free bond. C. Government bond. D. Real estate investment. Answer, B. Tax-free bond. 30. How can two different investments be compared? A. Only by pre-tax returns. B. By comparing their post-tax returns. C. By looking at historical trends. D. By considering only their interest rates. Answer, B. By comparing their post-tax returns.